I'm at REIT Week 2013 in Chicago, and joining me today is Scott Craig, Portfolio Manager with Eaton Vance. Thanks so much for joining us, Scott.
Great to be here.
How has the Federal Reserve's monetary policy impacted the REIT capital markets? And with REITs trading at elevated price-to-earning multiples, has this affected their cost of capital?
Yeah, there's no question that Bernanke's policies have significantly reduced the cost of capital in the commercial real estate business, including for REITs. That's the cost of debt, the cost of preferred equity, the cost of common equity. Capital is very inexpensive, and that has driven property values and has driven NAVs higher. I've asked a lot of CEOs what they think would be the impact of rising interest rates, and I think the answer depends on why rates are rising. If interest rates are rising for fundamental reasons, which means primarily an improving economy, then that improved economy would cause real estate cash flows to increase and property values should be okay. On the other hand, if interest rates rise for technical reasons, like an abrupt change in Fed policy, that could be much more problematic for real estate values, but it would also be problematic for other asset classes like stocks and bonds.
We've seen a handful of large REIT mergers in the wake of the market downturn. Are you surprised that more haven't occurred?
My answer actually would have been a little bit different as recently as Friday, because it was just Monday that the merger of Mid-America and Colonial was announced. And I think it's always the case in the REIT industry that the biggest barrier to M&A is the lack of a willing seller. And what you saw with Mid-America and Colonial is a merger that made a great deal of strategic sense and also had a willing seller, and so the parties were able to come together and do a deal. By contrast, there was an apartment REIT merger that was rumored last year that didn't happen, and that potential merger had equally good strategic rationale behind it, but what was lacking there was a willing seller. And so I don't expect to see a lot of REIT M&A just because there aren't that many willing sellers.
Which sectors do you expect to produce the most significant gains this year, and why?
I really like the apartment sector. I think fundamentals are likely to be better than expected, and relative valuations are very compelling for the apartment REITs. On the other side, I think the healthcare REITs are very expensively valued, and I think there's likely to be downward pressure on triple net coverage ratios, which could change people's perception of the risk of those cash flows.
Thanks so much for joining us, Scott.
Thank you very much.
I'm Carissa Chappelle for REIT.com.